Welcome. This accounting mini lecture covers predetermined overhead rates. When we're using any sort of job costing system, we are going to apply overhead using some predetermined rate. Now here on this slide, we see a few reasons why a company might want to do that. I can tell you that the primary reason that we want to do that is so that we can go ahead and record transactions throughout the accounting period. We're able to quote and estimate jobs in order to, give our customers an appropriate price for a given job or product. And in addition to that, we're able to go ahead and record the cost of a job during the period to match that up with our revenues rather than waiting until the end of the accounting period when we would actually have all of those actual cost for factory overhead, because there's always going to be some timing differences in when we know our actual cost, for example, when bills come in and that sort of thing. And so by using a predetermined estimated rate, we can go ahead and apply those costs rather than actually waiting on all of those invoices to come in. Now, let's look at an example. Here we have a company called Road Warriors that wants to establish a predetermined overhead rate so that they can allocate overhead to jobs. Now, the base that they're going to use is direct labor cost. That's a fairly common base. All companies are going to have to choose some sort of base. Most of them are going to choose something along the lines of direct labor cost, direct labor hours, maybe even machine hours. In this example, they're using direct labor cost. So our basic formula, we're going to take the estimated overhead for the period and divide by the estimated total activity. In this case, their activity is direct labor cost. So they've estimated overhead cost of $200,000 for the period, and they've estimated $125,000 for direct labor cost. This gives us an allocation rate of 160% of direct labor. Okay, so what this means is, let's say, for example, that they incurred $100 of direct labor cost for a given job. They would then allocate $160 for overhead on that particular job, because the $160 would represent 160% of $100. And they'll basically follow that same approach for every job. You would just take the amount of direct labor cost, multiply by 160%, or if you converted that to a decimal, it would be multiplied by 1.6, and that will give you the amount of overhead that you're going to charge to that particular job. Now, we know that this overhead rate is based on estimates. Therefore, it's fairly inevitable that we're going to have some differences between the amount of overhead that we've applied in a given period and the amount of overhead that we actually incur once all of those invoices are in and have been recorded. So that means we're just going to have to record an adjustment depending on whether our overhead has been underapplied or overapplied. Now, for our purposes, we're just going to assume that all of these adjustments are going to run through cost of goods sold. I can tell you that in reality, if a company came across a very material difference, for example, they had used a really poor estimate for their overhead base, and let's say that we were just way off at the end of the period, if it was a very material difference, we may have to prorate that between inventory and cost of goods sold. But for our purposes, we're just going to assume that we're going to adjust the difference through cost of goods sold. Okay, so let's look at an example here, okay? If the overhead applied during the month is more than the actual cost incurred, we have over-applied our overhead. If the overhead applied during the period is less than the actual cost incurred, then we have under-applied overhead. Now, let's look at the consequences. If we have under-applied overhead, then basically our cost of goods sold is too low, and we need an adjustment to increase the cost of goods sold for the amount of overhead that was under-applied. If we've over-applied overhead, the opposite is true. Cost of goods sold is too high, therefore we need to record an entry to decrease cost of goods sold. Thank you for watching this video on predetermined overhead rates.